My dear NRI friends, a heartfelt welcome to this week's edition of FMR Finance Weekly. We are so grateful for your continued support, encouragement, and trust in us. This is what truly inspires us to bring you fresh, valuable insights each week. Today, we are excited to present a topic that is very important to all NRIs and may have a significant bearing from taxation standpoint on NRIs. In today's video, we'll explore the top 7 taxation changes impacting NRIs from 2024-25 onwards. We hope you find this video both informative and helpful. As always, we are here to ensure you stay ahead of the curve. So sit back, stay tuned, and don't skip any part of this video as I'm going to tell you about the top 7 key changes in taxation for NRIs. I am Chaitanya Garg, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.
In the current financial year, several changes have been made in the taxation rules that may be important for NRIs to be aware of. Let's dive right into the first big change in this year's taxation rules, shall we? It's a bit of a shake-up in the income tax slabs under the new tax regime. And trust me, it's one you will want to keep an eye on. First up, the income tax slabs have been adjusted for FY 24-25, that is assessment year 25-26, with two key slabs getting a boost. The rupees 3 lakhs to rupees 6 lakhs slab, it's now rupees 3 lakhs to rupees 7 lakhs. And the rupees 6 lakhs to 9 lakhs slab has moved up to rupees 7 lakhs to 10 lakhs. A nice little nudge, right? Why the rejig, you ask? Back in February 2023, some perks were introduced like the standard deduction, raising the basic exemption limit, and upping the tax rebate under Section 87A for incomes up to rupees 7 lakhs. All designed to make you rethink sticking to the old ways. So, what do the new tax slabs look like now? Here's a quick snapshot. Up to rupees 3 lakhs, it's nil taxation. 3 to 7 lakhs, it's 5%. 7 to 10 lakhs, it's 10%. 10 to 12 lakhs, it's 15% now. And 12 to 15 lakhs, it's 20%. Above 15 lakhs, it stays at 30%. What do you think? Does this make the new tax regime more appealing to you? Or are you sticking with the old one? Now let's move on to the next change number 2 on our list. Besides tweaking the income tax slabs, the taxation rules have thrown in some extra goodies to sweeten the deal in the new tax regime. Curious? Let's break it down. First up, the standard deduction limit has been bumped up. From Rs 50,000, it's now a tad higher enhanced limit of Rs 75,000. That's an extra 25,000 in your pocket for those earning through salary or pension. Not bad, right? Next, family pensioners, listen up. Your standard deduction has jumped from Rs 15,000 to Rs 25,000, a solid increase of Rs 10,000. Every bit counts, especially when it's heading in the right direction. And here's a bonus. For all of you NPS subscribers, the deduction on the employer's contribution to your national pension system account has been raised from 10% to 14%. More savings, more tax benefits, more security for your future. Exciting changes, aren't they? What do you think? Are these updates making the new tax regime look a little more attractive to you? Now let's talk about number 3 on the list, one taxation change that's sure to catch the attention of startups and investors alike. The removal of angel tax. Sounds intriguing, right? Let's dig in. So what's this angel tax all about? Well, previously, if a non-public company issued shares to a resident or non-resident at a price higher than the fair market value, the excess amount was taxable in the hands of the Indian company. This tax, commonly referred to as the angel tax, has been a thorn in the side of many startups. Now here's where things got tricky. The valuation of those shares could be done through different methods like net asset value, discounted free cash flow method, and other methods. But valuation is never straightforward, is it? You have got assumptions about the future projections, discount rates, and the market value of underlying assets. so much room for interpretation. Naturally, this led to a whole lot of litigation. But here's the good news. The angel tax has now been abolished. It's a game changer. It's a massive relief for investors, especially non-residents, as it clears the air and removes the fear of unnecessary tax liabilities or litigation when investing in Indian companies. Now let's see the change number 4. It's about the taxation change for buyback of shares being recharacterized as dividends. Sounds technical. Let's break it down. Under the new rules, if you sell your shares back to a company in a buyback, the income you receive will now be treated as dividend income in your hands, rather than the company paying additional tax on it like before. And here's the kicker. The cost of those shares, it will now be treated as a capital loss which you can set off later. But here's where things get interesting for NRIs. This change isn't just about taxation. It could also impact your residency status. You see, the entire buyback proceeds will now be considered as taxable income, and that could push you over the 1.5 million limit used to determine your residency status for tax purposes. If your income crosses that threshold, it could reduce your allowed stay in India to just 119 days in a financial year rather than 181 days. A crucial point to note, right? The residency rules have been tightened over the past few years, and while there haven't been any significant changes in this year's taxation rules regarding the NRI residency determination, this buyback tweak could still affect you. What do you think? Does this shift in how buybacks are taxed make things a bit trickier for your financial planning? Dear viewers, we have just explored 4 major changes impacting taxation, and there are still 3 more to go. But before we dive into the next ones, I'd like to take a moment to share the wide range of services FMR offers. Our expertise spans direct taxation from income tax return filing, handling notices, and managing litigations and scrutiny cases, to providing tax consultancy and offering new business incorporation services and registration services, and the most crucial, undertaking all the associated compliance related assignments. Feel free to connect with us using the contact details below or in the description of this video. You can reach out to us via WhatsApp, email, and phone number. We are here and happy to assist you. Now let's discuss the change number 5, and it's a big one. A major shift in how we determine the holding period for capital gains. If you are investing in securities or assets, this is definitely something you will want to pay attention to. So what's changed? The intent is to simplify things by having only 2 holding periods to determine whether your capital gains are classified as short term or long term, either 12 months or 24 months. That's it. No more confusion about multiple time frames. Let's break it down. For listed securities like shares and units of listed business trust, the holding period is now set at 12 months. This means that if you hold these assets for more than a year, you will be looking at long-term capital gains rates. For all other assets, the holding period is now 24 months. This includes things like bonds, debentures, gold, and even unlisted shares or immovable property. The good news here, the holding period for assets like bonds, debentures, and gold has been reduced from 36 months to 24 months, which is a significant cut. What does this mean for you? Well, if you have been holding on to bonds or gold for the long term, you will now hit that lower tax rate after just 2 years instead of 3. The same 24-month period also applies to unlisted shares and property, which hasn't changed but is worth keeping in mind. This streamlined approach is definitely going to make things easier to understand, but it also opens up new strategies for managing your investments. Don't you think? Whether it's listed securities or long-term assets like property, these new holding periods give you more flexibility in how you approach your gains. So, how will this change the way you handle your investments? Are you excited about this shorter holding periods, or do they shake up your strategy a little? Now let's move on to the change number 6, and this one's all about the tax rates for short-term and long-term capital gains. If you are investing in shares, mutual funds or bonds, This change could have a significant impact on your tax bill. Let's break it down. First up, the tax rate for short-term capital gains under Section 111A has been increased from 15% to 20% for three key asset classes. First, STT paid equity shares. Second, units of equity-oriented mutual funds. Third, units of business trust. This means if you sell these assets within 12 months, you will be looking at a 20% tax rate on your gains. It's a bit of a jump, right? But don't worry, other short-term capital gains will still be taxed at the applicable rates as before. Now let's talk about the tax on long-term capital gains. The LTCG rate is set at 12.5% across the board, which is an interesting shift. Previously, the rate was 10% for first, STD paid equity shares, second, units of equity-oriented mutual funds, third, units of business trust, and for other assets it was 20% with indexation under Section 112, which included the sale of property. This reduction to 12.5% could offer some relief to investors, but it's definitely a shift from the earlier rules. Another win for long-term investors. The tax exemption on gains of up to Rs 1 lakh has been increased to Rs 1.25 lakhs for STD paid equity shares, mutual funds and business trust under Section 112A. A small but sweet bump. For those investing in listed bonds and debentures, the long-term capital gains tax rate will drop to 12.5% without indexation, down from 20%. However, if you are dealing with unlisted bonds and debentures, which are more like debt instruments, you will continue to be taxed at the applicable rates whether they are short-term or long-term. These changes could alter how you approach your investment strategy, especially with that jump in short-term capital gain tax. So what's your take? Are these new rates making you rethink your portfolio? And now we have reached the most anticipated change number 7, which has sparked quite a few debates, the removal of indexation benefit. This one's a game changer, especially for those dealing with long-term capital gains on property, gold and other unlisted assets. Here's what's happening. With the tax rate being rationalized to 12.5%, the indexation benefit under Section 48 for long-term capital gains is being phased out. Indexation has traditionally been available for assets like property and gold to adjust the cost of acquisition for inflation, but now that's been taken off the table. And yes, this change applies especially to NRIs. Resident Indians can still continue with the indexation benefit for properties purchased up to 23rd July 2024. As an NRI, if you purchased your property after April 2001, indexation won't apply. But if you bought your property before April 2001, there's still some relief. The cost of acquisition will be either the fair market value FMV or stamp duty value as on April 1, 2001, whichever is lower. Sounds a bit tricky, right? Let me explain with the help of an example as shared by the Income Tax Department. Say you bought a property in 1990 for Rs 5 lakhs. On April 1st, 2001, its stamp duty value was Rs 10 lakhs and its fair market value was Rs 12 lakhs. If you're selling this property on or after July 23rd, 2024 for Rs 1 crore, the cost of acquisition would be Rs 10 lakhs, the lower of the stamp duty or FMV. Using the indexation, the cost of acquisition in FY 2024-25 would be Rs 36.3 lakhs. Your long-term capital gain would be Rs 63.7 lakhs and at 20% tax rate, you did owe Rs 12.74 lakhs in taxes. Now, if you choose to forego indexation and stick with 12.5% LTCG tax rate, your tax liability would be 12.5% of Rs 95 lakhs. That is Rs 1 crore minus Rs 5 lakhs, resulting in a tax of Rs 11.87 lakh. So which is better? Well, there is no one size fits all answer. Whether the 12.5% rate without indexation or the 20% rate with indexation works better for you depends on your specific situation, especially for properties purchased before 2001. That's why it's always a good idea to consult with an FMR tax expert to figure out what's most beneficial in your case. And for my dear fellow NRI viewers, here's something critical. If you're selling a property, the buyer is required to deduct TDS on the full sale value, whether the 12.5% or 20% LTCT rate applies to you. However, you can apply for a lower TDS certificate which could help minimize your tax burden. What do you think? Are these changes making your head spin, or are they opening up new opportunities for smart tax planning? So that's it from my side. I truly hope you found this information helpful and insightful. If you have any questions or need further clarification, feel free to reach out to us. And don't forget to subscribe to our channel Filemyreturn. Your support means the world to us and helps us to continue creating valuable content to keep you informed and empowered. I am Chaitanya Garg, your tax advisor, making finance friendly.
FMR Finance Weekly. Simplify your life with our financial advice.